Hello, my fellow investors, and welcome back to another earnings report / stock analysis video. And today, guys, we are going to be taking a look at a company that, man, this company has just been through the ringer. It's been dragged through the mud, like very much, because, well, AT&T recently spun off their HBO segment, and Discovery has it. And I actually did cover this when we looked at the Discovery stock analysis, but nonetheless, though, this is very interesting because now they're basically working to make their telecom sector the best that it can be. So they're more centralizing. So they're mainly centralizing in this one sector. However, because of the spinoff, they lost a ton of revenue. So yeah, we're going to take a look at this fundamentals, guys, as well as the earnings, and see if at the current price is looking like a buy. So with that said, let's get started with this analysis. Now, let's start off with the earnings summary. We got EPS normalized actual came in at 60 cents, beat by 1 penny. EPS GAAP actual, 57 cents, beat by 1 penny. Revenue actual, $30.14 billion, which is a miss by $85.35 million. So guys, let us now come into their actual earnings report. And like always, this will be linked in the description below for you guys to read for yourselves. So let's jump into this. We got AT&T reports first quarter results, continued 5G and fiber subscriber gains, 424,000 postpaid phone net adds, 11 straight quarters with more than 400,000 net adds with continued low postpaid phone churn. 272,000 AT&T fiber net adds, 13 straight quarters with more than 200,000 net adds. High quality customer additions continue to drive revenue growth. Domestic wireless services revenues up 5.2%, best ever quarter-over-quarter mobility operating income. Consumer broadband revenues up 7.3%, driven by AT&T fiber revenue growth of 30.7%. Network enhancement and expansion momentum. Mid-band 5G spectrum covering more than 160 million people. Reliable nationwide 5G reaching 290 million people. Ability to serve fiber to 19.7 million consumer and more than 3 million business customer locations in more than 100 U.S. metro areas. Remain on track to pass 30 million fiber locations by the end of 2025. Lastly, transformation progress supporting margin growth, on track to achieve $6 billion plus run rate cost savings target before the end of the year. So all of that is sounding, I guess, really positive. However, I really want to take a look at this in regards to Q1 of 2022. We got over here first quarter consolidated results, revenues of $30.1 billion. Diluted EPS from the continuing operations of 57 cents compared to 65 cents the prior. Ooh, wow, that's not good. That's really not good. So that is a drop of what, 12 cents. So not good at all. Adjusted EPS went from 60 cents to 63. Okay, so that's another drop by 3 cents. So they're pretty much just dropping. Cash from operating activities, $6.7 billion. Capital expenditures, $4.3 billion. Capital investments, $6.4 billion. Free cash flow of only $1 billion. That's $1 billion just in the quarter alone. Doesn't really tell us much what happened in the year, but we'll take a look at that when we get to the calculator. So let's actually come, guys, into the CEO's comments. We got, quote, "Our teams take pride in connecting more people to greater possibility through the 5G and fiber," said John Stankey, AT&T CEO. "We're winning thanks to proven and sustainable playbook that centers in simple customer-centric experiences. As a result, we're adding high-value customers, and when they choose AT&T, they stay with us. The work we're doing today is establishing a foundation for durable long-term growth, and we remain confident in our full-year guidance." So that's pretty much, guys, a whole lot of nothing. And, well, unfortunately, when it comes to their financial tables, well, it's very difficult to read, especially for you guys to read. So I'm just going to leave this one as well linked in the description below. But just understand that it's, again, I'm not going to cover it because it's very difficult to read over here. But I will leave a link in the description below. Now, let's actually move over into the discounted free cash flow. Just take a look at these numbers at a much wider range. We got the ticker symbol for T, market cap of $125.8 billion. A PE of NA. That is not good at all. This is not because the calculator is broken. This is because they have negative net income. And you guys are going to see this in just 1 second. Current share price of $17.65. Now, for all those of you who know about this company, which I'm pretty sure there's all of you, you guys probably know that this company just doesn't move. In fact, let's take a look at this in the 5-year. You can see that it was just stuck between like the $20, $20, $22 mark. And then even prior to 2020, it was still around like the $20 mark, right? It went as high as what, $29 back in January 8th, 2019, right? But then it just doesn't move. It's just one of those companies that doesn't move. Now, unfortunately, after the spinoff was announced, then they came crashing down. In fact, taking a look at this, actually, let's go back into the 5-year. You can pretty much just see, so when COVID hit, they came down, then they remained pretty much stagnant up until they said, yeah, we're probably going to spin this off. Nonetheless, though, this kind of drop is still going on today. As we just saw on the 1-year, they're down 9.16%, and we just see this drop right here as of today. And looking at the year to date, well, they're still down 5.82%, and right here is when you really see it. Looking at the 52-week range, $14.46 to $22.72. In fact, looking on the day, guys, they fell 10.41%, absolutely massive. Post-market, they're a little bit up, but I mean 10.41% is absolutely gigantic, though. It's insane. So come back into the calculator. They do pay out a dividend of $1.11, which, to anybody who knows, this dividend was a lot higher. They actually ended up cutting it when they also announced their spinoff when it comes to Warner Media, and that actually rubbed a lot of people the wrong way, because prior to that, I kid you not, AT&T CEO came out saying like, don't worry, our dividend is safe, and then like 2 months later, oh yeah, we're spinning off Warner Bros. Media and we're cutting the dividend in half. So that pissed off a lot of people. And even with this cut, guys, this is still a massive yield of 5.63%, a payout ratio of 40.96%, a 5-year CAGR of negative 5.78, because again, they did cut it in half. And because they just cut it recently, 0 dividend years when it comes to growth of this dividend. Let's actually take a look at this dividend history when it comes to AT&T. If we scroll down, we can see exactly when this happened. They had it at 39 cents for a while, actually. So wow, yeah, look at that. 2018 is when they had it at 38, then they brought it up to 39 in 2019. They kept it at 29 at 39 for pretty much the entirety of 2021 and 2020, and then they cut it from 39 to 28 cents in April 12, 2022 when it was announced. So yeah, that's that. Unfortunate. A lot of people really did depend on that kind of dividend, but it's gone. Ex-dividend date passed as of April 6th. Payout date will be on May 1st, and they pay their dividends quarterly. Let's come back into the calculator. Based off the current shares outstanding and this $1.11 in dividends, they pay out almost $8 billion in dividends every single year, which in regards to the 5-year average free cash flow, they're still left with $15.8 billion. As of their last year's free cash flow, unfortunately, it is way down to $4.5 billion. These payout ratios are interesting because 63.82% doesn't seem too bad for the last year's free cash flow, even though you can see that massive drop right there. And on top of that, their 5-year average is still looking fairly good at 33.35. However, there's one thing with AT&T, and I don't necessarily know, well, I think this is a sector-wide thing because, guys, AT&T has a ton of debt. We're talking in the several hundreds of billions of dollars worth of debt, which is not good, right? That's really not good. But then again, Verizon is the same thing. And I don't quite remember if T-Mobile is similar to that. Maybe one day when we cover T-Mobile, I will take a look at the debt specifically, but I do know that Verizon is very similar when it comes to their debt situation. So now let's jump into their fundamentals, because unfortunately, well, I can't really show you guys their tables without it being just very tiny on your guys' screen. So I may as well just do it my way over here. Still get the exact same thing, except not on the quarter view, but on the year over year. We got the net income, guys, of $19.37 billion to 1 year ago of negative $8.524 billion. That is a massive decrease of 144%. Now, okay, I fully understand as to why this occurred over here, right? I mean, the spinoff, that's perfectly understandable. And then on top of that, actually, not just one spinoff, multiple spinoffs. They also, as I said, they spun off their DirecTV, as well as they spun off their Warner Bros. So again, they're mainly focusing on the telecom part of their business. They're solely focusing on that. They're done with, like, you know, other kind of communication services. So it is what it is. Unfortunately, that is going to dig when it comes into their profits, and we're seeing this right here. Now, the 3-year-ago value going negative, that's perfectly understandable as to why, because I mean, COVID was 3 years ago, and you can see that it was COVID related, because the following year they shot up from negative 5.2 billion to 20.1 billion. So that explains that. Now, I gave this a 5%. It's more of just along the lines of, like, I don't know where this is heading. right? I don't know where this is heading. Sure, they're projecting some fairly good things, you know, in their earnings report overall, but at the same time, we only have 1 quarter. Like, I need more than just 1 quarter, and I do believe that I don't think that they have made a year yet. I think that the spinoff, when it came to Warner Bros. Media, just happened, I believe, late 2022, if not the beginning of this year. And I am actually so terribly sorry, because I completely forgot that, no, actually April 11th, 2022 was when the spinoff was completed. So it says right here, on April 11, 2022, AT&T completed a spinoff of media business Warner Bros. Discovery, WBD. So yeah, I am so terribly sorry for getting all of that incorrect, guys. So now, based off of that, I fully understand as to why this occurred, right? This was 1 year ago, 2022. Was when the spinoff occurred. Perfectly understandable. The problem is, I have no idea. I don't have a concept as to where this is going in the future, right? I just don't. So I personally would like to wait a few more years, maybe like, I wouldn't even say a few more years. I would say this year, the end of this year, to see where this actual net income goes to. But for now, I'm going to give it a 5%. Looking now at the free cash flow. Again, not surprising that 5 years ago, we did $22.35 billion, and then 1 year ago, $12.4 billion. That is a decrease of 45% with an average of $23.726 billion. Guys, I mean, from 4 years ago to 1 year ago, it's just been consistently decreasing. And of course, from 2 to 1 year ago, that's when we saw the massive drop because of, again, the spinoff. Overall, I'm going to give this a 15%. Same exact reasons I mentioned in the net income. Looking now at the revenue, this one's, again, fairly surprising. From 4 years ago, that was their peak at $181.2 billion. Now, looking at the 5 year ago, we did $170.76 billion. And as of 1 year ago, it was $120.74 billion. Decrease of 29.29%. Again, very, very similar to that of the free cash flow. 4 years ago was the peak, as you guys see right over here. And then they just decided to drop afterwards. Now, I'm actually going to give this, I give this a 5%. I'm tempted to give this, actually, I'm gonna give this like a little bit of a higher grade than that of the free cash flow, because there's less dramatization right here from like 4 to 3 to 2 to 1 year ago. So I'm gonna give it like a 20%. I mean, they're still in the positive, but man, it's just that consistent decrease is really, really sad. It's just really, really bad as well. Looking now into the assets minus the total liabilities, we could see pretty much the exact same thing over here. I mean, positive, sure, but at the same time, it's like the massive drop from 4 to 3, okay, COVID related. Then we saw a little bit of an increase from 3 to 2, and then the massive drop as of 1 year ago because of, again, the spinoff. So I'm not necessarily sure where this is going. But then again, this probably, to be fair, them getting rid of Warner Bros. Media got rid of a ton of debt. So let's actually look into this fundamentals to be more exact. Now, we got over here, guys, their total assets and total liabilities. We can see that, well, it's been roughly at around like the $530 billion mark for a while. And then as of 1 year ago, they came down to 402. That's actually okay, I guess you could say. But then looking at the liabilities, 338, 350, 350, 360, and then $300 billion worth of liabilities. So that's good. I mean, they got rid of over $100 billion in, well, I wouldn't say over. They got rid of almost $100 billion in total liabilities. But because of that, they also got rid of a little bit more than $100 billion in their assets as well. I don't really know where to put that at, to be honest with you all. Nonetheless, though, average total assets, it is $486.95 billion. Average liabilities is $331.4 billion. Doing the difference, we get $155.58 billion. I'm going to give this a 15%. I mean, no negatives. That's really, really good overall. But at the same time, it's like they still have a ton of liabilities, guys. On top of that, they're still paying a dividend, which I'm not really a fan of. So I'm going to get to that when we get to the dividend section. Now, looking at the cash flow minus the liabilities, fairly surprising because that cash flow is coming down. Yet you can see here that from 4 to pretty much 1 year ago, with the exception of 2 years ago, this is actually getting smaller and smaller. In fact, 1 year ago, it is negative $284 billion, which is a lot lower than their average of negative $316 billion. I'm going to give this guys a 40%. This is actually not too bad. Looking now at the shares outstanding, the silent killer when it comes to investing, we can see that well, they're buying back shares with the exception of just 1 year from 3 to 2 years ago. Aside from that, they have been buying back shares. On the 5 year, it was 7.3 billion shares to today of 7.13 billion shares. That is a decrease of 2.11%. And from the previous year to the current year, it's almost a buyback of 1/5%. I'm actually going to give this a 95%. This is actually a really, really good metric overall. And lastly, cash and equivalents, they currently hold $3.7 billion, an average of $9 billion. Looking at the overall grades, guys, we give them the income of 5%, free cash flow 15%, revenue 20%, assets minus liabilities 15%, cash flow minus liabilities 40%, social standing of 95%, overall grade of 29. Yeah, main problem here, it is the net income, pretty much the profit metrics, right? That's pretty much it, specifically the net income. They have problems, guys. In my personal opinion, I like it if they were to just fix this first before me putting money into them. Which, by the way, I did own them before the spinoff occurred. And this was before I did any of like the stock analysis, before I even knew what shares outstanding even was, right? So I bought them. They were paying me a pretty good dividend. Then they said that they were going to cut the dividend, and I was one of the first ones that got out. So I didn't lose too much, but nonetheless, though, it still hurt a lot. So unfortunately, 29%, guys, is just not in my wheelbarrow right now. So now let's come into the discounted free cash flow to see if the current share price of $17.65, this is looking like a buy. Without inputting anything, guys, we got the target share prices of $9.17. Interesting. Target share prices adjusting for debt. It's the negatives, they just have a lot more debt than do cash and equivalents, so we can pretty much ignore all of these. Let's take a look at just the target share prices. Now, okay, here's the thing. Looking at Seeking Alpha, oh boy, we got here the forward revenue of negative 9.76. Yikes, that's bad. I don't know if this is taking into account the spinoff. So I'm actually going to give them the benefit of the doubt. I really am. Because they're solely focusing on the communication side, I'm going to say, you know what? It's fine. They're going to keep growing this revenue from the communication side. So I think this is going to be fine. Sure, is it a hit because we're comparing it to other years, previous years where they had, Warner Bros, where they had DirecTV? Sure, but I'm going to essentially not look at that, if that makes any sense. I'm acknowledging it, but I'm saying that it happened, it's done. If they're trying to focus on this new section to make it better, I'm going to give them the benefit of the doubt. Yes, it's going to be lower, but at the same time, it's more centralized, so it might be a lot better. So for that reason, I'm actually going to go in the positives when it comes to this. I'm going to give it a revenue growth of 3, 5, and 7%. And now for the protected share buyback, well, they've been buying back at around 2%. So let's just go with 1, 2, and 3, with 2 being the median, 1 being the lowest, and 3 being the highest. And with that, guys, we get the target share price of $10.30 to $12.07. Obviously, adjusting for debt, as I said, negatives, we can pretty much ignore this because it's based off their debt. Guys, even with a positive revenue, with a positive protected share buyback, it's at the best case scenario, you're still at $12.07. Current share price is $17.65. It needs to drop a little bit more, unfortunately, but it is what it is. Now, will they fall there? I mean, who knows? But at the end of the day, every investment is the present value of all future cash flow. If you guys believe that they'll do, let's just say 15% revenue growth, well, now you're getting a lot closer to the $17.65. In fact, if you were to have bought this at the 52-week low of $14.46, then, you could have actually bought that back then. But for me personally, I just think that 7% in revenue growth is a lot better. Yeah, it just needs to fall. It's sad. It really is sad because this company, it paid a lot of dividends for starters. But in my personal opinion, guys, when it comes to this dividend, it's just not something that I think is going to last. I'm going to get to that in just 1 second. But nonetheless, though, as I said, guys, not financial advice. Every investment is the present value of all future cash flow. So please use these calculators for your own benefit. And of course, read all their earnings. And even I'm going to link this as well, so that way you guys could see it for yourselves. Fortunately, again, I couldn't cover it, but you guys can look at it for yourselves. All we're asking for in return, guys, for daily content, the occasional live stream, more content to come down the line. Believe me, I am planning on it. All we're asking for, guys, is just like, subscribe, comment. It really does help here with the algorithm on YouTube. Thank you so much for everybody who have done that. I believe we are at 2,414 subscribers. Y'all are crazy. I wonder, can we get to 2,500 by the end of June? That would be absolutely crazy. So if you guys like this kind of content, again, I'm not forcing anybody to watch this. To people who have a bad opinion of my content, I'm not asking even for a course, okay? I'm not asking for like, join my course to figure out what's happening. No, I'm giving this all out for free. I'm literally only relying on YouTube, like, paid ads, which are barely paying me anything. And all I'm asking for in return, guys, is just, your support by liking, subscribing, and, just watching the video. That really helps a whole lot. And of course, word of mouth. If you think that I'm doing a good job and you would like to see upcoming shows like the documentaries that I was talking about, and even maybe if I can get enough support on this, maybe even like a show where one of my friends that delves a lot into precious metals, maybe he might do something like that if you guys like it. So again, I'm trying my best to give you guys more and more content. And the best way that you guys can help us just grow, guys, is just, again, like, subscribe, comment. It really does help. So now let's jump into this dividend. Now, I don't promote anybody buying a company solely for its dividend, even if it has a high yield, because it could be a trap. Now, this company's payout ratios don't look too bad, but the amount of debt that they have is insane. Even after the spin-off, they still have over $200 billion worth of debt, guys. So looking at this yield, putting in $5,725, this nets you $360 in annual dividends, which is insane. That's insane. But they have a ton of debt, and in my personal opinion, this dividend should be cut. I know I said it, probably people don't like it. And again, I'm a dividend investor. I like companies that pay me a dividend. Yeah, I'm saying that it should be cut, because if I want AT&T, well, actually, let me put this, not if I want AT&T to last, and they can't last if they have over $200 billion worth of debt paying a dividend as well. Yeah, they cut it, but in my personal opinion, they need to solely focus on paying down that debt. They just need to, because it's an ankle. Like, it's such an ankle weight on them, and I do not want them to suffer. They could cut it, suspend it, whatever, for a few years, pay down the debt, get down to, like, I don't know, $50 billion worth of debt or something like that. Then if they wish to do so, they can reinstate the dividend and even double it if they so wish to do so. But right now, I personally would not be surprised if they cut it. In fact, I would actually be happy if they cut it or even suspend it. Now, looking at their options, guys, obviously the April 21st ones, it's about to expire like today when you guys see this video. So not surprising that they're pretty much worthless. Looking at the April 28th, though, it's still not a lot. It's still not a lot. So, $17 for a strike of $17.50 for the put side and $12 for the call side. That's really, really small. So I'm not sure what you would do with this kind of information when it comes to AT&T. Not the best stock options in my personal opinion. All in all, thank you so much for everybody watching this AT&T stock analysis as well as earnings video. I really wish I could have covered more, but it's just really difficult to show everything on YouTube right here. So, especially with the charts the way that they are, right? So, it is what it is. Again, everything will be linked in the description below. Anyways, guys, that'll pretty much do it for this video. Like, if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow us on the YouTube sites. Link is in the description below. So, with that said, peace out, and we'll see you all in the next earnings report video.